If you're considering a buy-to-let mortgage or property, it pays, literally, to know when and where you'll be taxed, as well as how to save money on taxes along the way. Buy-to-let can provide a source of steady income as well as capital appreciation. However, there are several taxes to take into consideration that can impact the value of your property investment. In this video, we'll explain the key points about taxes. First, let's talk about income tax. Rent is a form of income. Any rent you receive from properties must be declared on your tax return. How much tax you pay will depend on which tax bracket you are in. The standard taxpayer's rate is 20%, followed by 40% for the higher rate, and 45% for the additional rate category. Deductions can be made for certain allowable expenses, such as council tax, general repairs, and maintenance, insurance costs, and certain legal and professional fees. If the property is owned in a limited company, there will be the corporate tax instead of personal tax. We will talk more about corporate tax later. If you are looking to buy a property for investment purposes, i.e., a buy-to-let, you will be subject to paying stamp duty land tax. The amount of tax depends on the value of the property. Stamp duty land tax applies to both a rental property and also to a second property that you may wish to purchase. It is worth noting that the amount of stamp duty paid will be subtracted from any capital gains made once sold. When you sell a buy-to-let property for more than what you paid for it, you are making a profit. The capital gain, depending on the level of capital gain and on your level of earned income. The capital gain tax rate is either 18% or 28% for individuals. However, there are several possible deductions that may allow you to reduce capital gain tax, such as stamp duty, fees paid to estate agent and solicitors, and certain capital item expenditure, such as the cost of a loft extension. A qualified tax accountant will be able to work out all the details for you. The amount of inheritance tax you will have to pay on a buy-to-let property depends on your individual circumstances. If you own the property outright, you will be taxed if the combined value of your estate goes above £325,000. If you are married, the threshold doubles to £650,000. Anything above this is taxed at 40%. These are generic guidance. Always seek professional advice when dealing with inheritance tax, as it is a complex field. Unfortunately, there is no straightforward answer to this question. That said, it's worth mentioning that with a limited company, you can treat mortgage interest payments as a business expense to reduce the gross rental revenue amount over which tax is charged. Also, limited companies pays a fixed corporate rate of tax of 19%. Individuals' income tax rate depends on the level of income, and it can be 20% for basic rate taxpayers, 40% for higher rate, and 45% for additional rate taxpayers. Transferring your buy-to-let property to a limited company could also trigger stamp duty charges and capital gains taxes. You would need an expert opinion from qualified tax advisor to assess your specific situation. Tax is a specialist area. The information provided here is only general and not specific to any individual circumstances. It is an overview of regulations only, and it is not legal or tax advice. Your mortgage expert's endeavors to remain accurate and error-free, but we cannot guarantee it, especially as tax regulations change regularly. It is always recommended that you seek professional legal and tax advice before taking action. If you need additional help with your buy-to-let mortgage, contact one of our knowledgeable mortgage advisors and call us today.